Imagine two businesses opening on the same street. One borrows heavily to grow as fast as possible, chasing every available customer within the first year. The other refuses outside investors, avoids debt almost entirely, and grows at a pace that looks almost too cautious to succeed. A decade later, only one of them is still standing. Why? The easy answer is religion. Most people assume Amish businesses survive because their owners reject technology, live simply, and follow tradition. That explanation feels tidy, but it doesn't hold up. Amish carpenters use pneumatic tools. Amish furniture makers ship products across state lines. Amish-owned manufacturing shops compete directly with modern companies and often outlast them. Something else is happening here, something structural rather than spiritual. The real story isn't about what Amish business owners believe. It's about how they're forced to operate and why those constraints turn out to be a competitive advantage. On the surface, an Amish-owned sawmill or bakery looks like any small business. There's a storefront, a payroll, a set of customers. But underneath, the incentives are built differently. A conventional business owner is often rewarded for growth, for taking on debt to scale quickly, for chasing market share even at the cost of stability. An Amish business owner operates inside a community that actively discourages those behaviors. Growth that outpaces the owner's ability to personally manage the business, or that requires heavy borrowing, is viewed with suspicion rather than admiration. This creates a strange paradox. In most industries, the businesses most celebrated are the ones expanding fastest. In Amish communities, the businesses most respected are the ones still standing after 20 years, run by the same family, employing people from the same church district. The central question worth asking is, why does an economic culture built around restraint end up producing such durable outcomes? Start with debt. Most small businesses fail not because their product is bad, but because they can't service what they owe when revenue dips. Amish business culture treats heavy borrowing as a last resort rather than a growth strategy. Expansion is usually funded through retained earnings, meaning the business grows only as fast as it can pay for itself. When outside capital is needed, it often comes from family members or the community itself through informal lending arrangements rather than commercial banks. These loans tend to carry different expectations. A relative lending money to a nephew's woodworking shop isn't optimizing for the highest return. They're investing in a person they'll see at church every Sunday. That relationship changes the terms, the patience, and the willingness to renegotiate if a bad season hits. Low fixed costs compound this advantage. Many Amish businesses operate from existing farm buildings, use simpler equipment, and keep overhead lean by design, not necessity. A business with low fixed costs can survive a slow month that would sink a competitor carrying a large mortgage on a new facility. Slower growth, in other words, isn't a limitation. It's a form of insurance. Now consider labor. In most industries, skilled employees are a flight risk. Train someone well, and a competitor might hire them away within a year. Amish businesses largely sidestep this problem because labor is structured around family and apprenticeship rather than an open job market. A teenager doesn't apply for a job at a cabinet shop. He's raised inside one, absorbing the trade from childhood the way another kid might absorb a language. By the time he's old enough to be a full-time worker, he's already fluent in the business's methods, tools, and standards. This apprenticeship model produces something modern hiring struggles to replicate: deep skill transfer at almost no training cost, paired with loyalty that isn't contractual but relational. Compare this to a typical small business that hires from outside, trains someone for months, and then watches them leave for a $2 raise elsewhere. The Amish model doesn't eliminate turnover, but it dramatically lowers the odds of losing your most capable people right when you need them most. Shared identity does something an employee handbook can't. It aligns incentives without needing to enforce them. This is where the real insight starts to take shape. Most business advice, from MBA programs to startup culture, treats growth as the primary goal. Bigger is better, faster is smarter. But growth and survival are not the same objective, and optimizing for one can actively undermine the other. An Amish business owner tends to ask a different question than, "How big can this get?" He asks, "How long can this last?" That single shift changes almost every decision downstream. Expansion only happens once cash flow can absorb it. New equipment gets purchased with savings, not loans. A second location doesn't open until the first one is running without the owner's constant supervision. This conservatism produces a business that's harder to kill. When a recession hits and customers disappear for 6 months, a heavily leveraged competitor might default on loan payments and close within a quarter. An Amish-owned business with no debt and low overhead can simply slow down, wait, and reopen at full capacity once demand returns. Resilience, not speed, becomes the actual competitive edge. There's also a quieter advantage in how these businesses treat their customers. Growth-obsessed companies often optimize for constant new customer acquisition. Amish businesses, rooted in a fixed community and a reputation that follows the owner for life, tend to overinvest in repeat relationships instead. A carpenter who does shoddy work doesn't just lose one client. He damages a reputation that's shared across an entire church district, a mistake that follows him for years, not weeks. But individual discipline and family labor only explain part of the picture. There's a deeper layer, something closer to an economic safety net, that most outsiders never see operating beneath the surface. Here's the piece most explanations leave out entirely. Amish communities function with an informal but powerful mutual aid system, one that quietly absorbs risks a typical business owner would have to face alone. Take fire or storm damage. In many small businesses, a disaster like this means a scramble for insurance payouts, emergency loans, or in the worst case, closure. In an Amish community, a barn raising or workshop rebuild often becomes a collective effort. Neighbors show up with labor, materials get pooled, and the rebuilding timeline shrinks from months to weeks. The business owner isn't carrying that risk alone. The community effectively functions as an unwritten insurance policy, funded by reciprocity rather than premiums. The same logic extends to medical costs, equipment failures, and slow seasons. Informal lending doesn't stop at startup capital. If a shop owner hits a rough patch, a loan from a relative or fellow church member can bridge the gap without the paperwork, interest rate risk, or collection pressure of a commercial bank. This isn't charity in the traditional sense. It's closer to a long-term reciprocal system, where today's lender might be tomorrow's borrower, and everyone understands the arrangement will eventually balance out. Reputation acts as the enforcement mechanism holding all of this together. In a large, anonymous market, a business can cut corners, disappoint a customer, and simply rely on new customers replacing the old ones. In a tight-knit community, that option doesn't really exist. A supplier who overcharges, a contractor who misses deadlines, or a shop that produces inconsistent quality faces consequences that ripple through the entire social network, not just a single transaction. This turns trust into an economic asset. It lowers the cost of doing business because contracts, lawyers, and formal enforcement become less necessary when everyone is accountable to the same community over decades, not quarters. Local supplier networks reinforce this further. Many Amish-owned businesses buy from and sell to other Amish-owned businesses, creating a localized economic loop. A furniture maker might source lumber from a neighbor's sawmill, who in turn buys hardware from another shop down the road. This doesn't just keep money circulating within the community. It creates supply chains built on relationships that have already been tested over years, meaning fewer surprises, more flexibility during shortages, and a built-in willingness to work through disputes rather than sever ties. None of these mechanisms individually would be enough to guarantee business survival, but layered together, family labor, low debt, community lending, apprenticeship, and mutual aid, they form something closer to a resilient system than a religious lifestyle. Each piece reduces a specific risk that commonly kills small businesses elsewhere: labor turnover, cash flow shocks, capital scarcity, reputational damage, catastrophic loss. Religion shaped the values that produced this system, but it's the economic structure itself doing the heavy lifting. Return to the two businesses from the beginning. One expanded aggressively, borrowed to fuel growth, and chased every available customer. The other grew slowly, avoided debt, and leaned on a tight network of family and community. A decade later, only one survived, and by now, the reason should be clear. It wasn't luck, and it wasn't really about religious tradition at all. It was about which business was structurally prepared to absorb the shocks that eventually hit every industry: a recession, a supply disruption, a key employee leaving, an unexpected disaster. Amish businesses are not immune to failure. Shops close, families change trades, and communities lose members to industries elsewhere. But the failure rate among Amish-owned businesses tends to run far below the small business average, not because of divine favor, but because the entire system is designed around minimizing the specific vulnerabilities that most often end small businesses: over-leveraging, unstable labor, weak community ties, and short-term thinking. What makes this worth understanding isn't just curiosity about a specific culture. It's a broader lesson about incentives. When growth is rewarded above all else, businesses optimize for speed, and speed often comes at the cost of resilience. When survival and reputation are the metrics that matter most, businesses naturally build in the kind of caution that protects them decades later. The Amish didn't set out to create a masterclass in sustainable business strategy. They built a value system around community, humility, and self-sufficiency, and it happened to produce one of the most resilient small business ecosystems in the country. Maybe the real insight isn't about horses, buggies, or the absence of smartphones. It's about what happens when a business is built to last longer than its owner's ambition, inside a community willing to catch it when it stumbles.